in this reaction to a bust, we could see 30 trillion in the balance sheet, an additional 20 plus. And every central bank around the world doing something similar, just because they don't have any other tool to deal with something that's basically free falling, not just markets free falling, actual banking.
You're watching Silver News Daily. Subscribe for more.
Silver is standing at the edge of a financial detonation, and the blast zone is global. David Hunter, a veteran market strategist, isn't just predicting a price rise, he's warning of an explosion, one that could send silver rocketing to $5,000 an ounce. Sounds insane, right? But what if he's right? What if we're on the brink of a historic revaluation of silver, fueled by a financial system in free fall? Banks are cracking under the weight of debt, liquidity is evaporating, and central banks are trapped in a corner. We've seen the warnings: bank collapses, runaway inflation, interest rate chaos. And in moments like these, when trust in paper money evaporates, one thing always happens. Hard assets take center stage. Gold is already making its move, but silver, it's still lagging behind. And if history tells us anything, when silver wakes up, it doesn't just rise, it erupts. Think about it. Just over a decade ago, silver surged to nearly $50 an ounce. In 1980, it did the same. But those were minor tremors compared to what could be coming. This time, we're talking about a full-blown financial seismic shift. A supply crunch, an industrial surge, saw a surge, and a monetary crisis all colliding at the same time. Hunter isn't alone in this call. Other experts are seeing the writing on the wall, and the smart money is already moving in. So what's really happening behind the scenes? Why are financial elites hoarding metals while the mainstream ignores silver? And most importantly, is $5,000 silver actually possible? Stay with me, because by the time we're done, you'll see exactly why this isn't just another wild prediction. It might be the most important warning of our time.
It's been a bull market, secular bull market. That's about to end. That's a huge deal, and I don't think people are really recognizing that. And of course, lots of people are trying to call a top here. They fought this market from October of 2022 on up, and kind of capitulated, finally jumped in on the bull side in the last, 4, 5, 6 months. And then all of a sudden saw this thing start to roll over and got nervous again. It's amazing. I saw a sentiment indicator this morning that shows we're basically at the highs of bearish sentiment that we've been at over many years. So back to the levels of October 2022 or October 23, even back to the 2020 levels. To have a 6% correction in the S&P that gets people that nervous and that bearish is a huge statement, and it really supports my view that we're about to move into what I call a parabolic final stage. That means you can cover an amazing amount of ground in just a few months. So from here, the S&P, my target is 7,500. That's 30% from here, or thereabouts. The Dow, same thing, 55,000, about 30% up. The NASDAQ, 40%. And, my target there was 25,000. And my target on the Russell, which is the laggard, I think we're about to see that gain more speed. And you could see as much as a 60% appreciation. My target is 3,300, and that's basically 60% from yesterday's lows. So amazing kind of performance if we see anything like that. And I say it could happen in a few months. It might stretch out to 4, 5, or 6. I don't have any magic crystal ball that can tell me that. But any of the, even if it happened in 6 months, that'd be a huge run up. I actually think it'll happen faster than that, but I'm just cautioning people, don't get caught in thinking there has to be a precise date. This thing will go as long as it goes. The thing that will drive it, and I think, again, people underestimate what this means. We are looking at an economy that's slowing, and with, as you mentioned, the tariffs was the big issue yesterday. People were getting scared that this is the 1930s again, where, we got into a trade war with the world, and it ended up in a depression. We're not going to see a depression, but I think we are going to see the tariffs have some slowing of.
Silver has always been gold's shadow, following its lead, but when it moves fast. History has shown us that silver doesn't just rise steadily, it slingshots. And every major financial upheaval has triggered a silver super spike. Let's go back to 1980. Inflation was spiraling out of control, and the US was struggling to keep the economy afloat. Gold surged past $800 an ounce, a historic high at the time. But silver? It didn't just follow, it exploded, soaring nearly tenfold from under $6 to almost $50 an ounce in just months. Then in 2011, silver did it again. As the financial system reeled from the Great Recession, gold broke past $1,900. But silver? It skyrocketed from $9 to nearly $50, delivering 400% gains to those who saw the opportunity. The pattern is clear. Silver lags behind at first, but when it wakes up, it overcompensates. And today, we're looking at an even bigger setup. Gold is already pushing record highs, central banks are hoarding precious metals, and silver? It's still sitting at a fraction of its historical peak, artificially suppressed and overlooked. But here's the key. This time, it's not just investor demand driving silver's breakout. There's another force at play, one that's bigger than anything we've seen before. The banking system itself is on life support. And when banks fail, silver doesn't just rise, it detonates.
Yeah, we are. I think this is a great day to have this because I think we just saw the bottom in this correction. As you know, yesterday the tariffs were the main news, and people panicked, and you start hearing calls for the end of the bull market. You have been hearing that anyway, but I think we bottomed yesterday. We rallied off that bottom, came back, towards the end of the day. Open today, up a little bit, and I think we're kind of bouncing around here. But I think we probably saw the bottom. The S&P came down right down to the 200-day moving average. Nasdaq slightly went through its, I think, 200-day. But what you're seeing here, I think, is the classic case of the market needing a rest. Came into this year pretty elevated. Rallied a bit from there to new highs. And in the last month, most of February, I was saying it looks like there's some work to be done before we move higher. And that's exactly what I think we've seen. We had basically a 6% correction in the S&P. I'm not sure what the number was on the Nasdaq, but probably close to a 10% correction. The Russell, which has lagged, got hit pretty hard, but it's fine too. The Dow got hit some. They all came down to levels I kind of expected. The SP went a little farther than I expected, but like I said, down to the 200-day. It looks to me like it's basically we're about to begin the final leg of this, as you say, 42. I think it'll end up being a 43-year secular bull market. Started in August of 1982. Dow back then was, I think, 780 at the bottom. So, the Dow yesterday got down to 42,400. It shows you how far we've come. And I think this last leg is going to be steeper than any of them we've seen so far. You tend to steepen as you move into a top. This is a huge top. Again, I've been at this for 51 years. I'm talking about a top of a market that for most of that 51 years, 42, 43 of them.
Banks are the backbone of the global financial system until they collapse under their own weight. And right now, cracks are spreading faster than most people realize. The same reckless policies that led to past banking disasters are back in full force. Runaway debt, fragile balance sheets, and an over-leveraged system hanging by a thread. But here's the real danger. This time, the safety nets might not hold. We've already seen the warning shots. Silicon Valley Bank, Signature Bank, Credit Suisse, gone overnight. And those were just the early casualties. The Federal Reserve tried to calm the storm with emergency bailouts, but that was just putting a bandage on a gaping wound. The problem runs much deeper. Banks have loaded up on risky assets, and with interest rates rising, those assets are crumbling in value. When a bank collapses, what happens next? Panic. Customers rush to withdraw their money, institutions scramble to cover their losses, and suddenly trust in the entire system evaporates. And history has shown us over and over, when trust is lost, investors flee to hard assets. They don't want paper promises. They want real money. They want gold. And they want silver. But here's where things get really interesting. Silver isn't just a hedge against financial chaos, it's a lifeline. In past crises, as banks wobbled and currencies devalued, silver outperformed nearly every other asset. And this time, the setup is even more extreme. The banking system isn't just fragile, it's one domino away from disaster. So what happens when the next major bank fails? What happens when depositors lose faith completely? The rush into silver could be unlike anything we've seen before. And with a chronic supply shortage already brewing, the price potential is staggering.
Yeah, I mean, silver's had a nice move today. Finally, it corrected this week.
Yep. And just to clarify for our viewers, we're recording this on Wednesday, March 5th. So
Yes. Yep. Yeah. So, last week and earlier this week, we had silver down. But I want to remind people, because there's a lot of people who say silver's done nothing. Silver was at its bottom in 2020 was 12. In 2022, it got up to 18. It's now, 32 and a half, let's say, on its way to, I think next stop is 36. After that, probably the mid 40s. And then from there, I'm calling for 75. And these are all numbers for this year. I'm not saying it's, 2 years from now. Silver's okay. It's lagged gold. It has been a little frustrating of late because it came into this year. Basically, it's been flat this year, flat to down. Yeah, probably flat to down a little bit. And the miners have been big laggards. So that frustrates investors. But again, it's kind of good timing today because I really think we are seeing the turnaround in both the metals and the miners, and that we basically bottomed out yesterday. So I do think, and by the way, gold has done obviously much better than that. Gold's at all-time highs or very near all-time highs. I have a target there of 3,400 this year, and I wouldn't be surprised if I have to raise that somewhere down the road. But for now, comfortable with 3,400. It's still $500 away, and it's had a nice run. I mean, it's moved up from broke out at 2,100 a year ago or whenever, and you've had pretty much a steady gain all year, all the past year. And so I'm very bullish. Probably my convictions are very high on the stock market having a final big run, as well as the metals having a big run here.
If banks are the trigger, then silver's historic undervaluation is the fuel. And right now, the most overlooked signal in the entire metals market is flashing red, the gold to silver ratio. For centuries, this ratio has been a key indicator of silver's true value. When the ratio is high, silver is historically undervalued compared to gold. And today, the ratio is still sitting at extreme levels, hovering around 80 to 1, meaning it takes 80 ounces of silver to equal the value of a single ounce of gold. But here's the catch. This ratio is completely unnatural. Throughout history, the average gold to silver ratio has been closer to 15 or 20 to 1. And every time the ratio has reached today's extreme levels, it has snapped back violently, with silver making explosive gains to close the gap. Let's look at history. In 1980, before silver's legendary surge to nearly $50 an ounce, the ratio collapsed from over 40 to 1 down to just 16 to 1. The same thing happened in 2011, when silver ran from $9 to almost $50. The ratio plummeted from over 80 to 30. And today, we're sitting at the same historic setup, but with even more fuel behind silver's move. Here's what this means. If gold continues its climb toward $3,000 or even $5,000 an ounce, and the ratio reverts to historical norms, we're talking about silver rocketing to $200, $300, or even higher. And if David Hunter's forecast plays out, where a financial crisis sends gold into the multi-thousands, silver wouldn't just rise, it would go parabolic. This isn't just speculation. The math is undeniable. Silver is sitting wildly undervalued, and when the gold-to-silver ratio finally corrects, the speed of silver's ascent could stun the financial world. But the real question is, how high could it actually go?
Well, before a bust, I'm still calling for a global bust, which I think is bigger than 2008-9, at least financially. Um, you'll see some ease, not nearly the big ease will come in response to the bust, not before it. But I'm just saying that the Fed will start moving more aggressively to the easing side, both on rates and probably a little bit on QE. They don't want to. They have been very, Powell's been very outspoken about not wanting to go back to, big money printing, what we saw last cycle. So I don't expect them to move quickly in that way. But I'm just saying, if the street gets to the point of saying, hey, the Fed's get, we've got the wind in our back again, that's what's going to drive this last leg. Ultimately, I think the economy moves into recession, and like I said, could even be entering one now. And stocks can rally in a recession as long as the street believes that the recession's controlled and mild. Where you're going to run into the problems after the top is when the reality sets in that the Fed's been too tight for too long. They waited too long to ease. They're still reluctant to ease in terms of money. The government's downsizing is having an impact. Tariffs are having an impact. And they ultimately wake up and see that the economy is not only a mild recession, it's going to be a much deeper recession. And then move from there into a financial crisis, which causes a bust. So, but for the next, between now and summer, I think any weakness is going to be viewed as positive because it means the Fed could be on board.
A price explosion needs fuel. And silver's biggest fuel source isn't investors, it's industry. Right now, we are witnessing an industrial demand surge unlike anything in history, and the silver market is not prepared for it. More than 55% of all silver demand comes from industrial applications. And this isn't just about jewelry or silverware, this is about the backbone of the modern economy. Solar panels, electric vehicles, 5G technology, medical devices, every one of these industries relies on silver, and demand is skyrocketing. Let's talk numbers. The solar industry alone now consumes nearly 20% of the world's silver supply, and that percentage is climbing fast. Governments around the world are pouring billions into renewable energy, with mandates pushing solar production to record highs. And here's the key. Silver isn't just useful in solar panels, it's irreplaceable. No other metal conducts electricity as efficiently in photovoltaic cells, meaning as solar expands, so does silver demand. And it's not just solar. Electric vehicles are another massive driver. Every EV requires 2 to 3 times more silver than a traditional gas-powered car. And with auto manufacturers shifting toward an electric future, demand is set to explode. Tesla, Ford, GM, every major automaker is locked in an EV arms race, and silver is at the center of it. But here's the real problem. Silver supply is shrinking. Mining output has been declining for years, and we're now facing a chronic supply deficit that's only getting worse. For 4 straight years, silver demand has outstripped supply. And according to experts, 2025 could be the breaking point. This is a perfect storm. The world needs more silver than ever, but the supply just isn't there. And when demand outpaces supply in a market this small, prices don't just rise, they explode. So what happens when an industrial metal with a critical supply shortage suddenly becomes the most sought-after financial hedge in a banking crisis? We may be about to find out.
In fact, certainly Doge, which is going after government efficiency, lots of layoffs there. We're going to see all those things impact, and I think the economy is slowing. If it's not in recession now, it very well could be in recession sometime in the second quarter. So we're that close to, I think, a negative GDP. The Fed's, amazingly, their last meeting basically gave the impression if we're going to have any cuts this year, it might be 1. And the street bought that. So you had people talking 0 or 1, and the traders had it down to, I think, 1 cut for this year. We're back up to 3 cuts. I think, the numbers are starting to come in surprisingly weak, and so it's getting adjusted. I think you're going to see 3 and probably more cuts than that this year, as not even the interest rate cuts from the Fed that matter. That's going to drive the bond market lower. You're going to see much lower rates. Like I said before, I think you could see a 2.5% 10-year within the next 6 months or less. Probably the next 3 or 4 months even. And the Fed's going to have to start doing some QE once they recognize how weak things are. They don't recognize it yet. They're still talking about everything being pretty solid. That could change in a hurry, and I think might see it in the March meeting that they finally say we got to stop QT, and that is what will drive the small cap stocks once they and drive the market. Once investors start saying the Fed is really easing and that we're in a new easing cycle, or that the easing cycle is going to continue and really ease with money, not just lower rates, that allows Wall Street, both buy and sell side, to start raising numbers for next year. And that's what I just saw Goldman's strategist on, and he was talking about he's lowered his earnings numbers for this year from 11%, the S&P earnings from 11% increase to 9%. And that probably makes sense. The economy's slowing. He's saying next year it's 7%. What this will, if I'm right about the Fed ease, what that will allow the Wall Street to do is start increasing numbers. You'll see them go not from 7 to 9, but 7 to 15 or 7 to 20, because if they really believe the Fed's in gear and you're going to see a big easing cycle, you'll see numbers move up. And that's what will drive the stock market. So that's kind of a long-winded response on stocks, but it will also do things to other assets that are very bullish.
If silver's industrial demand is the fuel, then price suppression is the lid on the pressure cooker. And when that lid blows off, the results could be explosive. For decades, large financial institutions have allegedly been manipulating silver prices, keeping them artificially low through paper contracts, derivatives, and strategic short selling. Unlike physical silver, which is scarce and difficult to obtain in large quantities, the paper silver market is a playground for manipulation, with banks and hedge funds creating silver contracts out of thin air to suppress its price. One of the biggest culprits? JP Morgan. In 2020, JP Morgan was fined nearly $1 billion for manipulating the precious metals market. And they weren't alone. Several major banks have been caught red-handed, using the same tactics to keep silver prices suppressed. But here's the problem. Manipulation only works until the physical market breaks. And that breaking point is getting dangerously close. Right now, the physical silver market is tightening at an alarming rate. The London Bullion Market Association, LBMA, and the COMEX exchange, the two main global silver hubs, are seeing record low inventories. Investors are pulling real physical silver out of these vaults faster than it can be replaced. And if these vaults run dry, the paper contracts become meaningless. We've seen this before. When banks and funds get caught in a short squeeze, prices can skyrocket overnight. Just look at what happened to silver in 1980 when the Hunt brothers attempted to corner the market. The price ran from $6 to $50 in months. More recently, during the 2021 silver squeeze movement, retail investors nearly forced another breakout, pushing silver past 30 an ounce in a matter of days before the market was artificially cooled down. But cooling it down won't work forever. If the physical supply runs out and major institutions are forced to cover their short positions, silver's price suppression will break violently. This isn't just speculation. There are whispers that some of the largest banks are already quietly accumulating physical silver behind the scenes, preparing for what's coming. And when the biggest players in finance start hoarding an asset, it usually means only one thing. They know something the public doesn't. The question is, will you be ahead of the curve before the silver price suppression finally shatters?
Yeah, it's the safety of the banking system. It's also if to do QE to expand balance sheet to the tune of 20 trillion, the Fed will be buying every treasury in sight, both long treasuries as well as short T-bills. They will buy everyone in sight, right? Because that's how you create money, is you buy the treasury holdings that the commercial banks have, the dealer banks have. You buy those and you deposit cash or deposit dollars in the banks. That's how you expand the money supply. So they'll be buying everything in sight. And also, investors will be looking for the only thing, they'll be running to the treasuries as the only thing that has the government backing and government guarantee. So the demand will be through the roof. And even though the supply is going to be large, it's not going to be large enough to keep rates from going negative, I think. Now that's on short rates. On, like I said, the 10-year might get down to zero. This all would sound ludicrous, except we saw it in 2020. Like I said, we got down to a 0.4 10-year. So zero's not that far from there. And this is going to be far more dire than what we saw in the pandemic. So, corporate bonds will not follow treasuries. People have to understand, not all bonds are created the same. Treasuries have a government guarantee, a government backing, explicit, right? Agencies have implicit backings, but the treasuries have explicit backing of the U.S. government. The government has a printing press through the Fed. So that's why that's viewed differently. If you're in a corporate bond, if you're in a junk bond, you're in trouble in that kind of a scenario. But if you're in even a single A, you may be in trouble. If you're in a triple A, depends on how bad things really get, but people are going to pay for that government guarantee. So the spread between even AAA and treasuries is going to get quite wide, and very wide between treasuries and junk bonds, as we saw back in 2008-9. So that's why, really, the only game in town will be treasuries.
If silver's price suppression is cracking, then inflation is the accelerant that could send it soaring past anything we've seen before. Because here's the truth. Central banks are losing control. For years, governments and policymakers assured the public that inflation was transitory. But the reality? It's deeply entrenched, and it's not going away. The Federal Reserve has been raising interest rates aggressively, trying to rein it in, but inflation remains stubborn. And here's the dangerous part. If they keep raising rates, they risk breaking the banking system. If they cut rates too soon, inflation could spiral out of control. It's a lose-lose situation, and they know it. History has already shown us what happens when inflation runs wild. In the 1970s, inflation soared into double digits, and gold responded by surging nearly 2,400% in a decade. But silver? Silver went even higher, rising from just 130 to nearly 50 an ounce, a staggering 3,700% increase. Now, with the U.S. national debt surpassing $34 trillion and deficits spiraling out of control, the only option left is money printing. And the moment the Fed pivots back to quantitative easing, injecting trillions into the economy to keep the system afloat, fiat currencies will weaken, and hard assets like silver will explode. But here's what makes silver even more unique. It's not just a hedge against inflation, it's a chaos hedge. When trust in the financial system erodes, silver becomes a monetary alternative. Historically, silver has been used as money for over 5,000 years, and when paper currencies fail, history tells us real money takes over. The signs are already here. Central banks are hoarding gold at record levels, preparing for an era of monetary instability. But retail investors and institutions are beginning to realize that silver is historically underpriced compared to gold. If inflation accelerates, the flood into silver could be unlike anything we've ever seen. And when that happens, the people still holding onto dollars? They'll be watching their purchasing power evaporate while silver holders witness one of the biggest wealth transfers in history.
The Fed balance sheet was $875 billion. So we're now up to, got up to $9 trillion. I'm saying in this reaction to a bust, we could see $30 trillion in the balance sheet, an additional 20 plus. And every central bank around the world doing something similar, just because they don't have any other tool to deal with something that's basically free falling, not just markets free falling, actual banking system free falling. And I could be wrong on that, but that's where I think we're headed. If we get something less than that, it's still going to be bad. But that's kind of what I've been saying this for a while, as you know, that the end of this would end that way. In terms of the precious metals, they'll get hit hard, but not as hard as equities. Probably silver could get hit very hard. If we go to 75 on silver this year, it could easily come back to where we are now or lower. If gold goes to 3,400, 3,500, it could come back to the breakout at 2,100. I wouldn't expect much below that. So, you do the numbers and they're not as big as the equity markets, but still big. Still don't want to suffer something like that. The difference between precious metals and equities is that post-bust, we'll have a cyclical bull market in equities, but they won't come close to the highs of this cycle. So, it's 7,500 on the S&P. Even if you go down 80% from 7,500, you're at 1,500. Even if you go up fourfold in a cyclical bull market, that only takes you back to 6,000. So you'll fall far short of the highs, the secular peak highs of this year. Silver and gold, on the other hand, silver's, I have a number at early next decade of 500, and gold maybe 20,000. So the next cycle is going to be very much a precious metal cycle, a commodity cycle. All the commodities will go through the roof simply because all that money printing, if they do indeed print 20 trillion, that will, with a couple year lag, start an inflation cycle that's bigger than anything we've ever seen here. We got 21% T-bills and 21% inflation back in the early 80s. I think we could see that surpassed easily in the early 30s and 2030s. So, it's a very extreme forecast, but we're nearing the end of a super cycle that's been in existence since the Great Depression. And that's what happens at the end of super cycles, is everything goes to extremes. So I think that's where we're headed.
If inflation is the fuel behind silver's rise, then the global shift away from the US dollar is the match that could ignite an unstoppable rally. Because right now, a quiet but monumental power shift is happening in the global financial system, one that could send silver soaring to levels most investors can't even fathom. For decades, the US dollar has been the world's reserve currency, the foundation of global trade. But that dominance is under threat. The BRICS nations, Brazil, Russia, India, China, and South Africa, are openly challenging the dollar's supremacy. They're accumulating gold and silver reserves, cutting trades in local currencies, and even exploring the creation of a new gold-backed trading system. Why does this matter for silver? Because when nations move away from the dollar, they move toward hard assets. If the global financial system begins to de-dollarize at scale, we could see a massive revaluation of precious metals. Look at what's happening right now. China is stockpiling silver at record levels, increasing imports while restricting exports. Russia is actively buying gold and silver as part of its strategy to bypass Western sanctions. The Middle East is shifting away from petrodollars, with Saudi Arabia now accepting multiple currencies for oil. This isn't just speculation. The dollar's dominance is eroding in real time. And historically, when trust in fiat currency declines, silver becomes a monetary lifeboat. But here's where things get really interesting. Silver is not just a store of value, it's also a strategic metal. Unlike gold, which is mainly held for monetary purposes, silver has critical industrial applications that make it indispensable in a post-dollar world. If BRICS nations move toward a commodity-backed financial system, silver could play a key role. Central banks that once ignored silver may suddenly need it in massive quantities, not just as an investment, but as part of their economic infrastructure. And with the West asleep at the wheel, the countries that move first may lock up supply before the rest of the world even realizes what's happening. This shift is not a theory. It's happening now. And once global institutions recognize silver's role in the next financial era, demand could skyrocket in ways that today's price charts simply do not reflect. So the real question isn't just will silver rise, it's who will own it before the world wakes up.
Yeah, what I think we have a global bust, as I define it, is something worse than what we've seen in post-World War II era. So in the last 80 years, it's not a depression. It's not going to last a decade. It's something that will be concentrated in a 12 to 18 month time frame. But it'll be worse than a typical recession, and it will come with a financial crisis that could be the worst in history, but certainly, comparable to 2008-9, and I think worse is why I'm calling it a bust, meaning bank failures all around the world. Um, we cleaned up our act some in the banking area in 2008-9. I don't know. We're probably going to be better off than some of the rest of the world banking wise, but it's going to be a big enough unwind around the world that it'll hit our backs very hard too. So that's coming. I think it probably starts sometime, maybe fourth quarter this year, maybe sooner, maybe later, but somewhere in there. Um, and as I said, we'll be moving towards a bust in terms of recession before that. If I were guessing, I'd say the top is by this summer in the stock market, but I don't know that. And what I expect to follow that is the biggest bear market we've had in the post-World War II era. I'm calling for an 80% peak to trough decline in the indexes. And so if you get an 80% decline or, 75, 80, whatever it is, that means you're going to almost everything in the market's going to get hit across the board. The only asset that I think really will hold up in the bust are treasuries, and treasuries of all maturities, both T-bills as well as long bond, and everything in between. And that's because you have a government guarantee there and a guarantee from a government that people trust. So around the world, investors will flock to U.S. treasuries because they don't know where else to go in terms of safety. So I expect the bond market to continue to rally while stocks are rolling over, while metals are rolling over, while most commodities are rolling over. That you could see a 0% 10-year rate at the bottom of the bust or at the top of the bond market. And that could be late this year or early, first half of next year sometime. 0% 10-year. We got to 0.4, I think, in 2020, during the pandemic. This would be a new high in bonds or a new low in rates. Short rates probably go negative. And the reason for all that is because of, they're gonna be slow to catch on and slow to want to do it because they're not going to want to do what they did last time. They're trying not to repeat the same mistake. But when you're faced with a crisis that's, free falling financial system, you all of a sudden have to abandon whatever you think you should do, and they will be pouring money in at a rate we've never seen before. We could see the Fed balance sheet increase by 20 trillion. I mean, the Fed balance sheet got to 9 trillion last, a couple of years ago, last year, I guess, and early last year, and has shrunk down to maybe 7 now. Prior to, when we went into the 2008-9 decline.
If the global power shift is one catalyst for silver's breakout, then Trump's potential second term is the wild card that could accelerate everything. Love him or hate him, his policies could send shockwaves through the financial system, and silver could be one of the biggest beneficiaries. Let's break it down. Trump has made it clear that if he returns to office, he plans to restructure the Federal Reserve, reintroduce aggressive tariffs, and increase deficit spending. These policies could create a perfect storm for monetary instability, inflation, and skyrocketing precious metal prices. First, the debt crisis. Under Trump's first term, the U.S. national debt ballooned by nearly $8 trillion. If he returns to power, experts predict even more reckless spending. Tax cuts, infrastructure bills, military expansion, all funded by more money printing. And when the government prints trillions to finance deficits, the purchasing power of the dollar erodes. And historically, when the dollar weakens, silver surges. Second, trade wars and tariffs. Trump has already signaled his intention to impose huge tariffs on Chinese imports, potentially sparking a second global trade war. Why does this matter for silver? because tariffs increase production costs, disrupt supply chains, and fuel inflation. And when inflation surges, investors flock to silver as a hedge. But here's where things get really interesting. Trump has hinted at returning to a gold or commodity-backed currency. If a second Trump administration seriously considers a gold or silver-backed system, it would force the U.S. government to reprice and accumulate massive reserves of precious metals. This isn't just speculation. During his first term, Trump repeatedly criticized fiat money and openly praised the idea of backing the dollar with hard assets. If such a move were even hinted at, silver prices wouldn't just rise. They would go parabolic. And finally, market instability. Trump's presidency was marked by some of the most unpredictable financial conditions in modern history. His return could trigger massive volatility in stock markets, foreign exchange, and global trade. And when markets get chaotic, one pattern always holds. Money rushes into gold and silver. The bottom line? Whether you see Trump's return as good or bad, one thing is certain. His policies could be rocket fuel for silver's rise. And if history is any indication, those who wait until the chaos starts unfolding may already be too late to act. Yeah.
Just over the hill, just over the mountain. And again, I'm giving you what I think. I've got a pretty good track record, but I'm not perfect and I can be wrong. So you have to kind of make that decision for yourself, but also just kind of understand it's one of those things where you're running up the mountain and running down it. And if you don't understand how easily psychology can pull you back in, getting out too soon here could lead to even worse mistakes for you on the other side. And then the big story is beyond the bust and beyond that bear market, there is plenty of opportunity. It's just not going to be the same opportunities you saw in the last 15 years. Cycles change. Every cycle has different leadership. This last cycle has obviously been a very big tech cycle and, up until recently, a healthcare cycle. The next cycle is going to be a huge commodity cycle. The commodity producers, commodity stocks will lead the market, and that includes precious metals, but also copper, nickel, every commodity, steel, all the commodities I think are going to go through the roof because of that huge money that gets printed. What happened is you spent decades rationalizing down capacity, saying, well, we're, just-in-time inventories and, commodities are, we can manage them more efficiently now. So, and plus, there was a move against, for environmental reasons, against mining, against oil drilling, etc. So what we have now is commodity production that can, fits the demand cycle now. But if you get this ramped up demand through the roof in the second half of this decade and into early next, you can have huge demand and limited supply, and that's why prices can go through the roof. So, for example, copper, which is, say, $4 now, can go to 20 or higher. Natural gas, which is maybe $3, can go to who knows what, 40, 50, who knows, because demand will go through the roof. And you can say, well, there's a lot of supply as natural gas. And, that's crazy. You'll be amazed how fast that supply gets eaten up in a very monetarily driven, commodity driven, industrial driven cycle. And that's what I think we'll have second half of this decade.
If everything we've covered so far, the banking crisis, inflation, de-dollarization, industrial demand, and Trump's wildcard factor, is building the pressure, then we're now at the moment where the lid blows off. The real question isn't just whether silver will rise, it's why right now is the moment everything is converging. Look at what's happening in real time. Gold is already breaking records, but silver is still lagging. Historically, this is the setup for silver's biggest moves. Physical silver shortages are worsening. Mining output can't keep up, vault inventories are depleting, and industrial demand is surging. Retail investors are waking up, and institutional money is quietly accumulating. Smart money is moving before the breakout happens. The Federal Reserve is out of options. Whether they raise rates, pause, or pivot, the endgame leads to silver soaring. And then there's the final trigger, the psychological tipping point. The moment silver crosses key resistance levels, $35, then $50, panic buying will kick in. Once that happens, the financial world won't just take notice. They'll chase silver at any price. History has shown us this moment before. In 1980, silver ran to $50 in a frenzy. In 2011, it happened again. But this time, the setup is even bigger. If David Hunter's predictions play out and gold surges past $5,000, then a $5,000 silver price isn't just a fantasy, it's simple market mechanics. So the final question isn't, will silver rise? It's, will you be positioned before it happens? Because once silver's price suppression shatters, once the market realizes just how scarce this metal really is, and once the financial chaos accelerates, silver won't just rise. It will move with a speed and force that could rewrite the rules of the financial system. The opportunity is right now. The window to act is closing. And history rewards those who recognize what's coming before it becomes obvious to the rest of the world. But before you make any moves, remember, this is not financial advice. Always consult with a professional before making any investment decisions.
Yeah, you have to, those numbers I've been throwing around, you have to understand yourself. And on the one hand, we're looking at probably the fastest returns in a market over the next 3 to 6 months. If I'm right that the Russell can go up 50 or 60%, and the Nasdaq 40%, and the S&P maybe 30%, Dow 30%, to have all that happen in 3 or 4 or 5, 6 months, that's huge returns that you normally have to work hard to get over 3 years maybe. To have a double-digit gain 3 years in a row is pretty good for most investors, right? And so it's easy, like right now, for people to say, I don't care what's coming, what Trump's doing, or what's going to happen with the economy. I can't afford to lose money. I'm getting out now. I just caution people, people have to do what they're comfortable with and what their risk aversion tells them to do. But just caution and know yourself. If you get out now and the market runs 30, 40, 50%, I can almost guarantee you that the majority of investors will be pulled back in, because that's how psychology works. And investor psychology is one of the most powerful emotions, if not the most powerful emotion on earth. And if you're missing a market like that, somewhere along the line, you're going to jump back in and say, well, I don't know that it's going to top. Wall Street's telling me we got 3 years to run before this thing tops. So you're going to end up getting out now, missing the bulk of that move, getting in at the top or near the top, and then riding down, the market, maybe all the way, maybe halfway, whatever. Everybody will be different. But so I just tell people, know yourself, know what investor psychology is like. And I can't advise people whether they be in now or be out now, or, when to get out. But just understand, I lay out what I think is coming. I don't have a crystal ball to know for sure, but what I think is coming. And if it plays out very close to what I'm talking, just know there's a lot of short-term returns here just ahead. Even though most of Wall Street's telling you it's time to get out, they get it wrong. When the crowd is telling you something, often they get it wrong. Most of the time they get it wrong. And right now the bearishness is very high. On the other hand, what makes this such an unusual period is that within months, we're talking about the biggest bear, if I'm right, the biggest bear market we've had in 90 years. And you certainly don't want to just sit and say, I'm a buy and holder and ride through that. I mean, it'll be the rare investor who's going to be happy that they, listened to the buy and hold crowd and stayed put and then lost 80 or 90% of their portfolio, their wealth. So just know, yes, you got some big returns just ahead, but there's also some huge risks.
So, after everything we've covered, the banking collapse, inflation, silver shortages, global de-dollarization, and a potential Trump 2.0, we're left with one final question. Could silver really reach $5,000 an ounce? At first glance, it sounds extreme, but take a step back and look at the forces in motion. In every major financial crisis, silver has surged violently, and this time the setup is unlike anything we've seen before. The difference between silver at $25 today and silver at 5,000 is the same difference between an economy that's under control and an economy in total collapse. And that's exactly what David Hunter is warning about. If confidence in the system evaporates, if the Fed loses control, and if hard assets become the only safe haven, silver won't just rise, it will be revalued overnight. We're talking about a once-in-a-generation event, a total monetary reset. Will it happen? No one knows for sure. But one thing is clear: silver's time is coming. The opportunity to position yourself before the chaos unfolds won't last forever, because when silver moves, it moves fast. So the question isn't whether silver will rise. It's whether you'll be ahead of the curve before the masses wake up. If you've made it this far, drop a comment below. How high do you think silver will go? And if you want to stay ahead of this financial reset, make sure to subscribe. Silver's time is coming. Are you ready? And remember, this is not financial advice. Always consult with a professional before making any investment decisions.